Welcome to the VantagePoint Learning Center sessions, Getting the Most Out of VantagePoint Indicators, the Predicted Differences. VantagePoint's predicted differences provide a unique set of analysis tools for the trader. It's comparing the predicted and the actual moving averages. But beyond that, they will tell you something about things that traders often want to know. First, momentum. What is the market momentum? Is it getting stronger or weaker? Next, you want to know what the trend is. The predicted differences will help you detect the trend, and not only the trend, but the strength or the weakness of the trend. And then, the predicted differences can also be used to monitor longer-term moves if that is your particular style of trading. The predicted differences in VantagePoint provide several important clues to trends and strength of trends. The first area we will look at is the crossover of the various time lengths in the predicted differences. As you can see those on the bottom of the screen, we have the long-term predicted difference, which is the blue line, the dark blue line, the medium-term predicted difference, which is the pink line. The medium-term difference is comparing two medium-term moving averages. The long-term difference compares two long-term moving averages. It is in the crossovers of these two lines that are the key signal for the future trend of the market. An important part of that is the angle or the slope of the line. It should be the same as the predicted moving average that we showed in another video, another session with the VantagePoint indicators. As you can see, when the line starts to move down, that suggests that a turn may be coming. In this case, a crossover did occur. Another important aspect of the predicted differences is the relationship of these lines to the zero line, this black line that goes through here. As you can see, in some cases, the predicted differences come down to the zero line and bounce back up, which suggests that the trend in force will remain in force. In other cases, when it crosses below that line, that suggested that the market is changing from a generally strong status to a weak status or a bearish status. Another important aspect of the predicted differences, if you take a look over a longer period of time, you can see, if we're at the hard right edge of the chart here, that the level is at 20. And if you go back through time, coming clear across this line, you can see historically that 20 area has generally marked an area where you might suggest the market is becoming overbought. The same is true on the bottom at minus 20, where you travel this line across here. You can see that is a line that in general has indicated a line where the market may be becoming oversold. This is not particularly a signal. It is simply a matter of looking at what is happening with the predicted difference in a historical context. Now we're going to turn to the daily report to show you how it looks on the daily report. Some people are more oriented to looking at the visual chart, and they can see much more on the chart than they can see in numbers. Other people are more used to looking at numbers. In this case, you can see here we have the predicted long-term difference, predicted medium-term, and short-term. All those numbers are indicated on the daily report. When you look at the daily report, the red numbers suggest the numbers are on the weaker side. They're all below that zero line. As they start to move up, you can see that we have a progression of higher predicted differences. In that case, it indicates that the trend is moving up and is a stronger trend to the upside. Now let's go back to the chart, emphasize a couple of points again about the predicted differences. The first is the change in the angle. When it starts to move up, starts to move down. First alert that the trend might be ready to change. Secondly, the crossover situation here, which is a very good indicator of something different that is happening to the momentum of this particular market and could be a clue for a trend reversal. Another thing to watch, the predicted long-term difference line, the dark blue line on this chart. That line is a key. If the market is going up, the long-term difference line is going up, and usually when you're trading, especially longer term, you want to be on the side of the long-term difference, whichever way it is pointing. Now let's review some of the key points about the predicted differences. First of all, you have a number of different time frames that you can use depending upon the time that fits your trading style. Secondly, important consideration is the crossover that suggests potential market moves. The angle of the line suggests the direction of the move. Then it is also important to look at the relationship of the predicted difference line to the zero line, because that indicates the trend mode, whether it's bearish or bullish or weak or stronger. Then the next thing is, if you want to look at historically, how high, how low has the predicted difference gone in the past, and it may suggest an overbought or oversold situation. And then finally, if you would like to look at the long-term difference line as a single line, one particular line to look at in VantagePoint indicators, that is the clue sometimes to the longer-term moves. As with the other indicators, I want to emphasize, be sure to use this indicator in conjunction with other indicators. Thank you for watching this session. Please visit the Market Technologies Learning Center for additional tutorials.